Hello, everyone. Welcome to the Final Bar. Today, my guest is Jeff Greenblatt from Lucas Wave International. Going to talk to us a little bit about the time and price relationship. I love talking with people who are more engaged with cycles to see how that relates to what I'm seeing purely on analysis of trend. And speaking of trend, today week, by any measure you can come up with, certainly capitulating into the close of the S&P down another 3.5% today. So we're going to start looking left and seeing where we're at relative to where we need to be. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we review the charts together, applying the lessons of technical analysis, behavioral finance, everything else we can to anticipate trend reversals, to first identify the trends, follow the trends, and then anticipate trend reversals. And, certainly what we've seen in the last couple trading sessions is this follow through to the downside. Today, certainly, pushing lower, and it felt like there was a bit of a stagnation to the sell off there toward in the afternoon session, but really accelerating into the close. I haven't looked at the end yet. We'll look here in a moment about how about advancers versus decliners. I would expect this to be another 90% day, and that cluster of more than one 90% down day within a week, within a couple days for sure, certainly would suggest to anyone looking at breadth that things have the potential to get a lot worse from here. Just the conditions are lining up to that. So we're going to look to the left on a lot of charts here, and in a segment later called Mindful Investor, we're going to focus on a group of stocks to identify where they're at relative to some key levels. Now, we have some great guests coming through the show. As always, Jeff Greenblatt joining us from Lucas Wave International today. Tomorrow, we have Dana Lyons from J. Lyons Fund Management coming back on the show. Dana was joining us in end of January. It's just before the market peak, sort of when a lot of stocks are peaking out there in mid to late January, and had some great thoughts about extreme sentiment and potential for a sell-off, and ended up being a pretty timely set of comments. So I'm very interested to revisit some of those thoughts as we look at the data now. Also, we just finished recording a little while ago today, The Pitch, which is one of our regular shows where we have three guest panelists all pitching their best ideas to you today, or it's going to air tomorrow. We had Mark Newton from Newton Advisors, John Kosar from Asbury Research, Aaron Swenlin from Decision Point, moderated by our own Grayson Rose. It's going to be a really fun conversation. I'm excited to share that with you tomorrow, called The Pitch. Next week, coming up on the 4th, we have Frank Capillari joining us from Instant. That should be a lot of fun. So as we get to our market recap, as I mentioned, by any measure, today was pretty painful. And if you're buying into the buy on the dips idea, and that you want to buy on weakness, days like today, in my opinion, certainly much more characteristic of bear phases than bull phases. You are going to have up and down swings in any phase in the market, and any uptrend will have down days, any downtrend will have up days. But when we look at things like breadth, look at advanced or decliners, it's all about looking at the characteristics today, or in this little slice of time, versus on average, right? What tends to happen in bull cycles and bear cycles? That's what a lot of work with breadth and sentiment is really built off of. And again, I think this sort of move, this sort of follow through, certainly suggests, in my opinion, the potential for further weakness is very real. And if you haven't been thinking about downside risk and where you might be, managing potential downside, I'd certainly be looking at them now. The S&P down 3.5% today, just above 3270. Mid caps and small caps down as well, but not as much. So this was really led by energy, but then technology and communication services. Some of these big, sort of the big cap FANG trade really pushed the markets lower, sort of the opposite of everything else selling off, but a small number of stocks holding steady. This was everything down, and the VIX now spiking above 40 for the first time in quite a while. We're going to get to as many of these individual charts as we can in our 30 minutes, but I think we're going to end up touching on a lot of different themes here. Bonds essentially flat today while equities sold off, and the dollar probably up the most of anything we'll look at, sort of gapping higher and then remaining high through the expanse of the day. Commodities down across the board, so it was really sort of everything. Gold down 1.6%, silver over 4%. This is coming off some sort of choppy sideways themes that we've talked about. Even cryptocurrencies getting hit, with Bitcoin Cash the only one of the top 10 that we follow up on the day. We're going to hit on a couple of these charts here and just sort of focus on the overall takeaways here. So this is the S&P chart we've been working with for quite a while. The warning signs that I've been talking about have been this purple shaded area, this purple haze, if you will. We talked about sort of the no man's land right at the midpoint between 3,200 and 3,600. That broke today in a pretty significant way. We're now sort of in the margin of error of this blue shaded area. And as I mentioned a number of times before today, I think I wouldn't be surprised if we get down to 3,200. The question is whether or not that's going to hold. And I think now you have to be focused there, right? Especially given the sell-off today, what sort of follow through do we get? Are we able to hold this range, which started really from June? This was the peak in early June. It became support resistance again in July, support in July, and then once again, just perfectly, lining up with that September low. And so I think now, all eyes there. If we would break that, maybe the 200-day is next. But overall, we're, really, I think that holds, or you think about retesting these June lows, and all of a sudden we're getting down to the 3,000 level, which seemed unreasonable, 120, 200 points ago when we were a little further up, and it felt like we're retesting highs. But now you're seeing the internal weakness, and I'd love to switch to this guy. Here we go. Percentage advanced decliners. Let's look at where we actually ended the day. So we have a couple different ways to measure advancers decliners. Here I'm doing it by price. So I'm saying what percent of the New York Stock Exchange down on the day versus the total number. Now, I will tell you, when you hear things like 90% up days or down days, there are a lot of different ways to do this. Some people are talking about volume. Some people, like Walter Deemer, a mentor of mine, likes to use the Lowry approach, which is looking at volume, but it's also looking at advancers over advancers plus decliners and ignoring the neutral rate. And there's a lot of different things. I tend to just look at advancers and then decliners as a percentage of the total, and just imagine a little bit of wiggle room to make an adjustment for that. And what we've had is a cluster of pretty negative days here. A 90% down day based purely on price. Really haven't had one of those completely since June, one of these big sell-off days there. So, what's interesting is in in the later stages of the sell-off in September, you had almost a 90% down day there. And that ended up being pretty near to the bottom. That was like the last big down day. So it's interesting. We're getting another 90% down day almost at the same price range, this sort of same level. That's the bar that I'm highlighting here. So I think, again, we've now approached support. And again, the general way I would think of this is you assume support is going to hold because it's already been established. If it fails, that's where you have to, assume and start looking further down in the chart and looking at next levels. If we would break 3,200, 3,000 would be my next objective, which is basically going back to the June lows. I don't think that's unreasonable, and even further down is certainly possible. It seemed very unlikely, but days like today make it feel a lot more likely than before. Just the increase in decliners day to day is really the theme there I would pay attention to. Continuing on to some of these other themes we can go through. So as I mentioned, technology, energy, communication services, the three weakest sectors. Industrial is not too far behind, and then sort of everything else in terms of what worked the most, which is still down over 2%. Real estate, financials, materials. This is pretty much a broad distribution by any measure. A lot of times it's interesting with these scooter rankings. I did a presentation earlier for the Money Show, had a virtual event. I talked a lot about the scooter rankings, and in particular, we're looking at in a time like this, stocks that are highly rated in the scooter rankings, something like L Brands, which has been the number one stock for a while. These are the leadership names. These are the stocks that have had the strongest trends up through today. And so the question is, how are these able to hold, right? Do you see a big rotation down in these leading stocks? Something like L Brands, again, today was painful. Don't get me wrong, it was down almost 4%, but overall hasn't even made a new swing low, right? So still the trend remains very positive. So I think it's important to put things into proper context. This certainly was distribution, but there would be plenty more to have to see on a chart of L Brands to feel like this was getting a lot worse, right? At this point, it's still holding up okay. Doesn't mean it can't, but again, I mean, something's still above upward sloping 50-day moving averages. It hasn't come down that much relative to the strength of the trend, but looking for some of those names and seeing as they rotate lower, if they start to break, maybe FedEx could be an example of something that, is starting to, we're actually breaking to a new swing low. That's a little concerning. So again, that basket of stocks may be an interesting one to pay attention to see which ones are able to hold, which ones are breaking, and whether they're able to. Again, it's always looking where we're at, look left on the chart, and see what's holding up okay. It's worth noting again, even on a big distribution day, you did have stocks that were working, and this is another really good time to look at stocks that are gaining in their scooter rankings, because what that means is while everything is pretty much selling off, these are some stocks that are actually holding up okay and improving on a relative basis compared to their peers. So ADP, the biggest gainer, gapping up today, and these are going to be a lot of earnings names. Obviously, stocks are able to bounce up. GE is another one. We've talked about that rotation as it's broken to a new swing high and starting to follow up a little bit, holding up pretty well today, up as well. In terms of industry groups, not much working. Renewable energy equipment is a group we're actually talking right now about where to store this, but includes solar names. First Solar is one that was up pretty significant today, gapped higher, and that's what's pushing that group higher. Also noting home construction. These are all the home builders actually flat on the day, again, while everything's down. So this is a really good time when there's distribution to look at things you are in, holdings, portfolio names, client holdings, and making sure you're very clear with what levels you would cut your losses and start to think about further downside risk. Also looking at some of these groups that are holding up pretty well in a down tape, because those are the ones that may be attractive here as we continue to have the uncertainty of chopping around as a broad equity landscape. We need to take a quick commercial break. Back with my guest, Jeff Greenblatt. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Very much appreciate you joining us every weekday for our show after the close. As a reminder, get your questions in. We'll do another mailbag segment at the end of this week. And we'd love to hear from you, answer one of your questions in our next mailbag segment. Couple ways. Number one, via email, thefinalbar@StockCharts.com. Number two, on Twitter @FinalBarSCTV. Or on our YouTube channel, just put a comment below the video and we'll gather all those questions, get to as much as we can in our next mailbag segment, end of this week. I want to welcome on my guest back to the show, Jeff Greenblatt from Lucas Wave International. Jeff, as you and I have probably talked about, I'm not a huge cycle person. I don't use a lot of time relationship tools, which is why I really very much enjoy having someone like you on the show to talk through what you're seeing and how the cycles are lining up. So thanks so much for coming and joining us today.
Well, glad to be back. And this, using the time element, is actually the most precise way that anyone can participate in technical analysis and strategy for trading. That's my opinion, but you'll see on the chart, and maybe I can persuade a few of you that that's right. The first chart that we're looking at is the Dow, what is that, the hourly? Mm-hmm. And that's the setup that led us to the mess that we are currently in. And I want to show you a concept in price and time squaring in vibration work called replication. From the high, we're looking at three pivots. One is 661.36 points up, okay, and that establishes the secondary high. Now, where this starts to get interesting is that the second high at 28,575 is actually a 61% retracement from the secondary high. So we see what we have is the same number vibration repeats over and over, but just in different ways. And it takes a lot of patience and discipline to learn this. So don't anybody try this at home until you understand how this works. But basically, one bounce is 661 points up. The second bounce is a 61% retracement. The third bounce, which is now defending the new established trend line, is 60 to 61 hours off the high. So you see three different applications of 61. And for those of you who are into golden spirals and Fibonacci, it doesn't always have to be 61. It's just the numbers are different, as you'll see when we get to my 1 minute trading charts. Now, the only other thing that I want to say about this market is that we're a week out from the election, and I anticipate a lot of craziness. I remember 4 years ago that all the futures brokers, they raised the margins around on election day because they want you to be careful. I think this year is going to be even crazier. And finally, I think we're in a position right now where we're selling the rumor, and they may very well buy the news next week after the election. So none of this is surprising me, and actually it's a very cherry setup to see the 361s and the gap down. I mean, I love those kind of setups, and I love to see those setups on a 1 minute chart.
Your second chart.
Moving over to the 1 minute chart.
Good.
This is my personal trading charts. And basically, you're looking at the YM is very similar. I'm on the micro E-mini, and what you're basically seeing is a high that I've put in bold at 551 at 34 minutes after the hour. Now, everyone, look at this very carefully. The secondary high is at 51 minutes after the hour, and it's 35 points up from that little low at 509. So you see that you have the same numbers repeating, only in a different application. First of all, 551 price, 51 minutes after the hour is time. You have at the top 34 minutes after the hour is time, and then it goes 35 points up. So price and time squares out, and then you get a nice drop. And that's basically how it works. But in order to pull this off, one has to study these charts a long time so that so you can actually program your mind to act quick on this. So when you see something happening, you'll understand it.
So Jeff, we only have about 30 seconds left, but I'd love to ask on this 1 minute chart. So you're using the Fibonacci counts, right? Counting the bars from the low. How do you actually select that low? Is it because it's a meaningful price level, or is it just because it's a meaningful pivot among the trend? How would you identify that starting point?
Which low are you talking about? The 509?
Yeah, this is on your 1 minute chart, sort of that first bar, your second chart. You started the day count or the bar count at a certain low. Around 4.
Oh, that was the actual low. It's like any pattern you would look at, you would take a low or a high. That just happens to be the low on a 1 minute chart for that particular sequence in that 2 to 3 hour sequence of that particular trading day.
Right. Got it. These are two really interesting charts, Jeff. And again, I love hearing from you just to remind myself to think about some of these cyclical relationships and how to try to start to incorporate them into my own thinking. Jeff Greenblatt from Lucas Wave International, thanks so much for joining us today.
Thank you. And this happens every day, all the time on all charts, in case anyone was wondering.
Perfect. Thanks again, Jeff. Stay safe. We'll talk to you again soon, all right?
Okay, bye-bye.
That was Jeff Greenblatt from Lucas Wave International. Again, as you probably know if you've watched the show for a while, I'm not a huge cycle guy, and I have spent a lot of time talking with guys like Jeff, people following Gann analysis and other disciplines, just to understand. I value talking to someone with a very different toolkit than my own, because I know what my charts are saying, and if you can find some some comparison, if you can relate what you're seeing to someone from with a totally different toolkit, a lot of times that gives you at the very least something new to think about. Our next segment is called the Mindful Investor. The goal here is to take a step back, think about more mindful ways to approach things. It seemed like an opportune topic, a great opportunity on a day like today, when it feels like everything is rolling over, a lot of things are down. Obviously, the picture has appeared to change for a lot of investors I know. So what do you do with it? So, on days like this, I think it's all about a proper context, right? And as we've talked about, I'll start with this. On the chart of the S&P 500, we've been talking about this 3,200 to 3,250 level for quite a while. We've been talking about the potential for the S&P to return down, even when we're up here in the 3,500 range. We're talking about if we would sell off, that's where you have to look, is at those previous lows. All a day like today has done is gotten us a lot closer to that level in a short period of time. It doesn't change. Nothing really has changed in terms of this range. We're still range bound between 3,200 and 3,600. And again, as we've talked about, if the market pulls back, which it has, I think holding this is a reasonable expectation. If it doesn't, you will hear my manner of approaching things start to get a lot less optimistic and a little more bearish, because I think you've now broken through a key support level. And I think the risk of moving material lower is very real, when it wasn't when we're retesting the previous highs. But it doesn't mean between 35.50 and 33.50 we need to change things necessarily as a longer term investor. So it's important to identify some of those key levels and then not worry about where we're at relative to them, just focus on the levels. The reason why I'm starting there is because we talked at one point about the mindful six. This was at the after the June peak. The market peaked in June, pulled back, and I created this group of stocks which I called the mindful six, which were basically 6 stocks that had broken out along with the market, had pulled back a little bit, and the question was, are we going to hold these levels or not? And when we got to sort of that late June period, and the S&P is kind of coming back to those lows, you can look at a chart of the S&P to determine whether or not it's going to hold. That's fine, but I also like to look at individual stocks and see which of those are actually able to maintain support or not. And the more of those names that would break down, the less optimistic I would be about the index's ability to hold up. In the end, most of these names held those lows. Nike's probably the best example of just hitting it to the T and then just returning it to that uptrend and continuing on up to the 130s. I mean, really accelerating out of those lows. Disney may be one of the most clear examples of a breakdown that then failed, right? It sort of returned back and very quickly. And the fact that Disney was the one that broke down and then quickly, didn't follow through, sort of rotated back higher, certainly confirmed from a, sort of an anecdotal breadth perspective, if that's a thing, that the markets were going to be okay. Now I think it's a good time to revisit this mindful six, because they all have kind of a similar pattern. The S&P, as we've talked about, has come back to that 3,200 level. I put this blue horizontal line lining up the June high, the July lows, the September low. Now we're nearing that level once again. And I think the ability of 3,200 to hold pretty significant, because if we break that, I think that it opens the door to much further downside potential. But let's look at some of these 6 stocks as well. Applied Materials, you can see a similar level here. It's around 54, and that actually lines up really well with the low from June. Not all of them are that clear, but that's sort of the level that we would hold. We're kind of getting right near to that point today here. The second is Morgan Stanley, and this is, so again, a number of different sectors represented here. The swing September low around 46 or so, maybe a little bit below there, and again, that's where we would want to hold. What's interesting there is it lines up really well with its 200-day moving average. You have confluence of support right about here. We can do the same analysis with Starbucks around $82. With Cisco, we're going to come back to that one because it's actually already broken. Nike's a little complicated. And then Disney. So these are the ones that are actually in play. The rest of these sort of holding above support, and you want to see where they're going. Cisco is the first to actually break that level. Did it yesterday. So actually, Cisco has been in a much different configuration than many of these. Broke down through its June low after trading higher, going to a new swing high here in early August, actually rotated gap down and has continued to be in a downtrend since there. We've highlighted Cisco in other contexts, but not particularly with this one. So, it continues to be in a downtrend and has already broken down through that 37 level, which is low there. So 1 out of the 6 down below. Nike is an interesting one because it's been in such a strong trend and has a gap here. I basically took the upper end of that gap, basically saying if it fills the gap and keeps going lower, that for me would confirm that breakdown. It's right at that level, hit the level of 120 today. Disney would be the second of the 6. It's already broken down. It broke down through that today, also back below its 200-day moving average. If it follows through there, that would be the first time since August it's really remained below its 200-day. We'll see if we see the follow through through the remainder of this week. But now we see 2 of the 6 stocks that have now broken down through their swing lows from last month. And this is when the S&P 500 has not. Now, again, there's nothing particularly special about this 6 individual names that I used to comprise this list. At the time, it was a group of stocks that I thought had a clear pullback level in June, lined up pretty well with the S&P, but represented a lot of different sectors. And the idea was just like looking at a breadth measure, if you could see some confirmation on there, that would sort of validate what we were seeing with the overall index. We'll keep tracking this list of stocks as we go forward in the coming weeks. And again, at this point, my quick anecdotal evidence, I'm going to dig a little further into this with some other charts, but I see 2 of the 6 having already broken down. So the S&P not quite below its swing low from September, but 2 of the Mindful 6 having already done so. So the main idea with this segment on Mindful Investor is don't, the uncertainty and certainly the downward push that you've seen in names like we did today certainly doesn't have to be an area of concern necessarily, and doesn't have to be a source of anxiety. Focus on the key levels now. Draw lines in the sand at which you would evaluate positions. Think about taking profits, removing, taking bets off, repositioning, reallocating, and just stick to those levels. And then you're just focused on the levels. You're not focused on the emotional reaction to what happens. We need to wrap the show and go to the 3 and 3 charts in 3 minutes. Let's get to it. Chart number 1 is looking at the percentage of advancers and decliners. As I mentioned, this is another 90% down day. I was talking with Walter Deemer earlier in the week after we had the sell-off there, and on a volume basis, looks like we triggered the 90% down day. I wouldn't be surprised if today is another one based on volume, which would suggest to me, again, it just increases the likelihood of downside potential. I wouldn't be surprised if 3,200 breaks, and I think making the case for further downside is a very real target. For me, my base case is looking down to 33,000, which is basically retracing down to the June lows, and then you have to reevaluate where we're at. But this cluster of down days is certainly an area of concern if you're thinking of this as just a buyable dip. Second, consumer discretionary. This is one of the bearish divergences we talked about here in mid-October. This is one of the reasons why I felt the caution was a little warranted. And this is the higher highs in price, lower peaks in RSI. And it wasn't just on the XOY. A lot of things in consumer and in technology had a similar kind of configuration. But 2 things that are interesting on this chart. Number 1, you can see we have a little room down to the lows there. 140 would be sort of that break. We break 140 on a closing basis. We've really pushed through those lows, and that would, I think, invalidate the break to new highs and sort of validate the potential for further downside. On the XOY, I think the 200-day would be a reasonable downside objective, which would basically take the height of this base and sort of putting it down, subtracting that from the low, which is a pretty reasonable thing. The second thing is the fact that the RSI is just breaking below 40, which if things are bullish and this is a bullish pullback, we should be holding around 40, not breaking down through that. So that's something I'm going to watch through the remainder of this week. Also, I think what's most telling, the XOY is still outperforming, so it's making a new relative high today, even as it's selling off. So interesting to know when everything feels like it's rolling off, this is a no better time to be looking at the relative strength line. And again, focus on owning things where that line continues to go higher. You're going to ride this out okay. Finally, when we're thinking about the S&P, there are a lot of ways to try to validate it. One other thing is the broad global equity markets. This is the MSCI World Index. The ETF is URTH, so it's about 50% US, 50% non-US. The world is pretty close to making a new swing low. That would be a break below 96. The RSI is already below the 40 level, which tells me we're more in a bearish range than a bullish range. That is a chart to be watching. We break below 96. I think the weight in the US, along with Europe and other developed markets, as well as potentially emerging markets, pointing lower rather than higher. Folks, that is our show for today. I want to thank Jeff Greenblatt from Lucas Wave International coming back on the show, sharing some of his thoughts on the price-time relationship. As a reminder, get your questions into us via email, on Twitter, on our YouTube channel. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.